and thanks for joining today. We have Rhona O'Connell, Head of Market Analysis for EMEA and Asia at StoneX, here to talk all about precious metals. So Rhona, thanks for joining me today.
It's a pleasure, Amy. Nice to see you.
Nice to see you too. So to kick things off, gold in large part has really been impacted by, major global economic factors, moves from the US Fed, and inflationary pressures. So what have been some of the major impacts on the markets and reactions from the gold markets this year? And where do you see things moving as we, close out 2023?
Well, the first half of the year has actually been really interesting in the way the dynamics played out. If we go back to last October, I was at the London Bullion Market Association annual conference, and someone came up with a beautiful definition of how gold was behaving. I wish it had been me, but it wasn't, so I can't claim the credit. But basically what he said was that gold wasn't responding to inflationary expectations, it was responding to how we expect the official sector or the monetary authorities to deal with it, which actually encapsulates it perfectly, because we spent pretty much all of last year and a fair amount of the year before, for that matter, looking at the Fed, trying to second guess what the hiking cycle was going to be, what it did to yields and so on and so forth. And the fact that real yields at that point were pretty much negative everywhere, which should therefore kill the argument about gold is not worth having because it incurs an opportunity cost, because it doesn't pay interest, etc., etc., etc. That didn't apply, but people were actually much more interested in looking at the nominal yield. So every time we got a hike, we got a knee-jerk reaction, down it went, and then it was stabilized. And obviously the prices are up and down according to different events and different influences. But it seemed to be fixated on the Fed. It really did. Until we had the period of March to May of this year, when I got terribly excited as an analyst, because it meant that I could actually go out and wave the banner and say, this is what gold is there for. It's not necessarily an inflation hedge. It's an imperfect inflation hedge if you're a professional investor, because you've got other alternatives like the TIPS bonds, for example. But what it does do and what it's there for is to mitigate risk. So when we had Signature and Silicon Valley, then the implosion of Credit Suisse, and then the problems with PacWest. And on top of that, what seemed like being the interminable negotiations or lack thereof about the debt ceiling, that's when gold actually came into play and it came to life, because it was acting as a hedge against risk and people were turning to it in times of uncertainty, which is basically its primary role in life.
Right. No, absolutely. So, you mentioned kind of the big banking issues that happened this past year. What are some other kind of big risk factors that might impact the markets or kind of economic growth globally? And so, how does that all play in terms of
well,
risk?
We can divide that into professional and private, if you like. There's the professional investor, who I tend to think of it as a sort of marine analogy. The professional investors are the hot money, they're the speedboats. And then behind that, we've got the private investors and the people and by investors, I don't necessarily mean private individuals who buy exchange traded funds. I'm thinking about the very high quality jewelry and coins and bars that the man in the street would buy. And they're more like the oil tankers. Their impact on the market, except in very, very short spaces of time, and last night's a case in point, they will help to cushion a fall, or they might be capable of capping a rise to a certain extent, but they're the background flows. So you've got those two elements. So as far as the professionals are concerned, the banking sector, I think, is probably something that we still should be watching. I'm not a banking specialist, but obviously I have to read what they're saying. And I've seen some pretty cogent arguments saying that banking stresses, albeit that the Fed and the Swiss National Bank were pretty quick off the mark earlier on this year, injecting liquidity and so on and so forth, they don't go away just like that. And we've already seen credit tightening, and the fact that banks are now looking to protect their own margins. And there was a very interesting piece by Goldman Sachs a couple of weeks ago, looking to the other side of the world, whereby with the slowing in the Chinese economy and the need for the government to continue to provide stimulus, and they're putting more in place now, quite a few of the banks over there, because of tightened credit, Goldman thinks may well have to pass their dividends this year and possibly into next, again, as a margin sheet bolstering exercise. So that then cascades into the private individuals and their level of discretionary expenditure and so on and so forth. So it does all link together eventually. Mm-hmm. So on the one side, we've got the professionals looking at banking stresses, and then you've got the banks actually with those stresses, and then what that does to private individuals, and particularly if we think about Asia and China, which are the world's two largest consumers with about 55% of jewelry and gold coins and bars between them of the world total. The Chinese people are not buying at the moment because they're nervous. India is in and out according to price. So they're there, but they're not rampant. So they've been supporting the price around about the $1,900 level. And with the very short movements that we've had in the days before you and I recorded this video, again, we go back to the United States and weakening economic signals, it's actually gained a little bit of life. So as you and I speak, it's trading at around about 1970, which is a decent clip from a fortnight previously.
Yeah, absolutely. You started to talk a little bit about kind of the physical purchasing. I know this isn't one of my questions that I sent previously, but maybe you can talk a little bit about kind of the impact that the physical markets might have in the overall kind of grand scheme of things.
Sure. Generally speaking, as I said, they won't necessarily be strong enough in and of themselves to generate a trend. That almost invariably comes from professionals. And that's a question of perception, obviously. As far as the physical markets themselves are concerned, though, while they may be able to cushion a fall, say, or cap a rise, because the markets are very quick, they're very agile, very nimble. Because we have the professional sector trading in so much volume, the underlying supply-demand balance, if we're talking about copper or tin or platinum, palladium for that matter, is less significant for gold because we've got that additional investment level of icing on the cake, if you like. But it is important at bottom, because we need to understand about the flows of the metal, where it's going, why it's going where it is. And more often than not, you will find that spot prices will be less important than individual local premia. So if we've got very strong demand in China, for example, people watch the local London-Shanghai dislocation or arbitrage between those two. And generally speaking, if the Chinese people are avid buyers, then obviously the onshore premium rises. There is a little bit of a wrinkle behind that too, because at the moment the People's Bank of China is not releasing gold licenses. That's because they're trying to strengthen the yuan. So that is actually pushing the premium up. So while physical demand is relatively quiet at the moment, it's not dead, but it's relatively quiet. The premium's actually telling a slightly different story because it's lack of supply because of what the government's trying to do with the currency. So on balance, going into the second half of this year, we've had reasonably robust demand in the first half, reasonably decent jewelry buying. It's quiet now. It usually is at this time of year, Western Hemisphere in particular, but also in South Asia. And generally speaking, when you've seen a move in price, it takes a little bit of time for any regional activity to pick up again, because they tend to stand back and wait for things to stabilize, whether it's coming off a rise or coming into a fall. So for the time being, we've had this little recent spike, so they're quiet, but they will come back.
Okay, interesting. There's been a lot of talk lately about kind of the impacts of central bank purchasing on the gold market. So can you talk a little bit about what that impact is, and maybe if there's kind of regional or geographic differences here?
It's probably the key to the whole puzzle, to be quite honest, Amy. Yes, there has been a lot of talk about it. We can certainly tell on the desk from the feel of the flows through the market that there's central bank activity out there. So there are a range of impacts here. One is that it looked pretty clear, quite a lot of people talking about it, about some interest coming in at around about the $1,900 level, which was a very important element of support. It's a ghastly term, but there is the debate about de-dollarization. And what that does, A, from the point of view of financial stability, query thereupon, and B, the longer term impact on the position of the dollar in official reserves. So that all ties in with diversification. And again, we're talking about risk hedging. So that would be another reason why some countries are looking to build up their gold reserves. There's also geopolitical risk, obviously, so that comes into play. But at the same time, we do have a couple of sellers. So it's not all one way. Turkey, for example, had problems. They had to suspend their gold imports for about 6 weeks in February and March, I think it was. I'm ashamed to say I can't remember the reason why, but there was a problem. So the Turkish central bank was actually a seller into the market over those 6 weeks or so, basically to feed burgeoning retail demand. And on the other side, we've got a little bit of top slicing from places like Kyrgyzstan, I think is one. But on balance, what the central banks are telling us, or the signal that they're sending, the fact that they were voracious buyers 2 years ago and pretty strong last year. They're strong this year again, obviously, but probably not to the same extent. They are sending signals to the rest of us that they see stresses and strains in the financial and geopolitical system, and therefore they're taking out the insurance policy.
Okay, interesting. Yeah, certainly sounds like kind of a big piece of the puzzle, as you mentioned.
Yes. Yeah.
So finally, I thought we could maybe look at silver, possibly the PGMs as well, but silver is kind of seems to be repositioning as more of an industrial metal. But what is the outlook for silver? How are you positioned for this metal, and maybe for the PGMs as well, in this kind of changing economy?
I just love the silver market. I get positively anthropomorphic when I'm talking about silver. For years, I've referred to it as Cinderella. And you could say that the ugly sisters are the dollar and the Fed. But I tend to call it Cinderella, or call her Cinderella, if you like, because there will be long periods where silver is off the radar completely. And then she'll come to the party with a burst and she'll entrance everybody. And we're talking price here, obviously. And then, just like Cinderella, when she leaves in more of a hurry than she arrived. You look at silver charts, frequently you'll see that they'll spike up and the fall when it comes is vicious. So if you want to trade silver, you've got to be incredibly quick on your feet. So that said, the important thing I think that we need to understand at base is that silver supply, all other things being equal, is pretty much relentless, and it doesn't depend on price, in the sense that only 30% of mine supply is from primary silver mines. The rest of it's from copper, lead, zinc, gold, and a few other odds and ends. We've also then got to wind in scrap supplies, which are a function of past industrial activity. And obviously, every now and then, if you've got prices at extremes, then that is going to make a bit of a difference. But on balance, it's going to keep coming regardless. So the destiny of the price is a function, A, as you say, of industrial activity, because that's about 60% of demand, unlike gold, where jewelry and coins are about 60%. And B, if gold is actually doing something interesting, that's when silver sort of decides that it's not an industrial metal after all, it's much more fun being precious one. What we've had over the last 18 months or so, therefore, has been a widening in the gold-silver ratio, which is a parameter that a lot of people watch, because when gold hasn't been doing very much, silver's been thinking of itself from the industrial side and looking at a weakening global economic environment. And therefore, sentiment hasn't really been terribly supportive at all. When gold moves, silver will almost invariably move by further, and typically the beta between them is 2 to 2.5, although recently it has been quite a bit wider. And if gold is showing a defined, discernible trend, then silver will go with it, whether it's up or down. And as I say, it'll go to a greater extent. Right. So I tend to, if I'm forecasting silver prices, which obviously I have to do, I will almost invariably, I'll look at the outlook for the gold market. And if it looks as if gold's going to be steady, then I'll take silver more seriously as an industrial metal. But generally speaking, and I know I'm not alone in this one, if we're off the silver price forecast, what we will tend to do is look at what gold's going to do and then adjust our expectations for the gold-silver ratio accordingly. So on that basis, I'm actually a bull of gold, not an outright one, not an aggressive one, but I think we've got sufficient geopolitical and economic and financial forces, see comments above about banking stresses, for example, to have tailwinds, better tailwinds for gold than we have headwinds. Mm-hmm. That suggests that we should see the ratio between gold and silver narrow. Gold is currently trading around about, as I say, just about 1970, 1980, with silver at 25. If we're looking at gold up towards 2050 or so, it's not a big move. Then we could probably see silver looking up towards 28, 29 at some point.
Okay, great. So, I mean, that was a kind of a great kind of overview of where we are with the markets. It was all the questions that I had today. Unless there's anything else that you want to add, any kind of closing thoughts on you know, what you expect for the coming year, or maybe it's hard to predict.
It is, as I say, I'm friendly to both gold and silver. I'm friendly towards silver because I'm friendly towards gold. The platinum and palladium markets have been in dire straits in recent months. Platinum is now starting to see quite a lot of industrial demand coming back again. Mm-hmm. Palladium is the one that's got the real problem, because between 80 and 82% of palladium demand in any one year, on a gross basis, before we think about any recycling activity, goes into the emission control sector, the emission control catalysts in the auto sector. With the electrification of the vehicle fleet, if it happens according to the current schedules, which I very much doubt, frankly, but if it were to, then by the time we get to around about 2035, 2036, which is a long time to you and me, but it's not a long time at all if you're a mining company developing your mine plan, then 80% of palladium demand in the auto sector actually turns into net supply, because there's no palladium in the internal combustion engines.
Right.
That almost certainly won't happen, because there's a lot of technological work going into palladium platinum substitution and so on and so forth. But it's got big problems, as has rhodium, for the same reasons.
Got it. Certainly a lot to be kind of keeping an eye on, as you say, as the energy transition kind of continues on and EVs hopefully ramp up. But yeah, so Rhona, I want to thank you for joining us here at the Assay and One-to-One today.
Great pleasure. Lovely talking to you.